Getting a mortgage in the UK. Wow, it can really feel like you're trying to solve some kind of impossible puzzle, right? It's one of the biggest financial decisions you'll ever make, and all the jargon can be just completely overwhelming. But don't you worry, we're about to demystify the whole thing and give you a super clear, simple guide to making the absolute smartest choice for you.
Okay, so here's the game plan. We're going to kick things off with the great broker debate. Do you even need one? Then we'll break down all those different mortgage types. After that, we'll tackle the big one, the hurdles for the self-employed. Then we'll get into the nitty-gritty of fixed versus tracker mortgages. And finally, we'll pull it all together into a handy checklist to help you make your move.
All right, first up, let's get into the great broker debate. This is probably the #1 question people ask themselves right at the beginning of their home buying journey. Should you go it alone or bring in a pro?
I mean, you see this exact question popping up all over the internet, and it sparks some seriously heated debates. It feels like everyone has a really strong opinion, which, just makes it more confusing for buyers. So what's the real story here?
And this right here just perfectly captures the two camps, doesn't it? On one side, you've got people who've done it loads of times, they're super confident, and they just go straight to the lender. But on the other side, you have people who swear by brokers, saying they are absolute lifesavers who just take all the stress off their plate.
So, what's the case for using a broker? Well, it really boils down to a few huge things. First, they can get you access to deals you literally can't find on your own. They're also pretty much essential if your situation is even a little bit complicated. And for so many people, the sheer amount of time and paperwork they save is worth it alone. It's like one application opens up the entire market. Okay, so once you've figured out how you're going to apply, you need to know what you're applying for. So let's decode some of that jargon and break down the main types of mortgages out there. Let's start with the big one, the one most people in the UK have, the fixed-rate mortgage. The appeal is just so simple: stability. For a set amount of time, usually 2 or 5 years, your interest rate is completely locked in. It doesn't matter what the economy does, your payment stays exactly the same. It really all comes down to a crucial trade-off here. The huge pro is certainty. It's amazing for budgeting. You know what's going out every single month. The con, you're locked in. So if interest rates suddenly drop, you won't get that benefit. And trying to get out of the deal early, that usually means paying some pretty hefty penalty fees. Now, let's flip the coin and talk about tracker mortgages. These are pretty much the opposite of a fixed rate. The interest rate isn't fixed at all. Instead, it tracks or follows the Bank of England's official base rate. So if the base rate goes up, your rate goes up. If it goes down, hey, so does yours. This is your classic risk versus reward play, right? The potential reward is that you could save a lot of money if the base rate falls, and they're usually more flexible, often without those early repayment charges. But the risk is pure uncertainty. If rates go up, your payments will too, and that can make budgeting a real headache. Okay, now for something a little different, an offset mortgage. This is a really clever product that links your mortgage directly to your savings account. You don't actually use the savings to pay off the mortgage, but instead, the lender just subtracts your savings balance from your loan before they calculate the interest.
It's a pretty fantastic way to make your savings work harder for you by reducing your mortgage interest, and you still get to keep access to that cash. But of course, there's a catch. You won't earn any interest on those savings, and sometimes the mortgage rates themselves can be just a little bit higher to start with.
Now, let's get into one of those complex situations we talked about earlier, and it's a big one where people often turn to brokers for help: getting a mortgage when you are self-employed. This quote from mortgage advisor Zita Latham just hits the nail on the head. It's not necessarily harder to get a mortgage, but the lenders, they look at your income through a completely different lens. They need a different kind of proof that you're a good bet. So what are they looking for exactly? Well, they want to see at least 2 years of your business history, and they want to see stable, or even better, growing profits. And they are looking at your declared profits, not just the money coming in. And here's the bit that can be a real balancing act. Being super tax efficient is great for your tax bill, but it can actually reduce how much you can borrow because lenders base their decision on that lower profit figure. And the one document that proves everything to the lenders is your SA 302. This is the official calculation from HMRC that shows your total income and how much tax you've paid. Honestly, if you're self-employed, this document is basically gold. And thankfully, getting your hands on it is actually really straightforward. You just need to log into your government gateway account, head over to the self-assessment section, pick the tax year you need, and you'll see the option to download it right there. And there you go. This is exactly what you're looking for on the HMRC site. Just remember, most lenders will want both the SA 302 tax calculation and the tax year overview, so make sure you grab both of those documents while you're there.
Okay, so whether you're self-employed or not, once you've got your paperwork sorted, you face the same massive decision. With everything we know, what's the smart play in today's market? Do you fix for that security, or do you go with a tracker for potential savings down the line?
Now, before we even look at the numbers, this piece of expert advice is absolutely critical. The lowest interest rate does not always mean the best deal. You have got to look at the total cost, because things like fees and penalty charges, they often matter way more than a tiny difference in the headline rate.
All right, let's look at the hard data. Based on a £250,000 mortgage, you can see right now that a 2-year fixed rate is actually the cheapest option per month. A tracker is more expensive today, which just shows the price you pay for that flexibility. And look at how the cost of long-term security goes up. That 10-year fix is over £100 a month more than the 2-year one.
So, we've covered brokers, the different mortgage types, the self-employed angle, and what the current market looks like. Let's pull all of this together now into a simple framework to help you make your decision. Think of this as your final checklist. First, be honest. Is your situation simple or complex? That will help you decide about a broker. Second, think about your future. Are you planning on moving anytime soon? That's going to influence how long you fix for. Third, always look at the total cost, not just the flashy interest rate. Fourth, have a real think about what matters more to you, the security of a fixed payment or the flexibility to change things up. And finally, a huge one for business owners, start planning your tax returns today for the mortgage you want tomorrow.
And that's a wrap. We've laid out all the pieces of the puzzle, but really only you can put them together for your own life. So, looking at your finances, your plans, your future, what is the single most important question you need to answer for yourself before you sign on that dotted line?